Welcome to Traditional IRAs, or How to Save for Retirement. Saving for retirement means different things to different people. When you are young, retirement is what your grandparents are doing. As we move through our middle years, our efforts are spent working and raising a family. And then one day we look up, and it's time to retire. Will you be ready? There are many different ways people save for retirement, including various plans through your employer, CDs, stocks and bonds, or digging a hole in your backyard and burying your money. But the focus of this course is traditional IRAs. We will be covering how to contribute to a traditional IRA, withdrawing from a traditional IRA, and taxable consequences. If you're taking this course for continuing education purposes, the following information may be relevant to you. This is a self-study course. It's in a taxation category. There are no prerequisites, and there is no advanced preparation necessary. The course level is a general overview of traditional IRAs. This course is a general overview of traditional IRAs. Upon completion, you should have a better understanding of the various types of traditional IRAs, the types of investments you can choose to invest in traditional IRAs, deductibility, if any, of a contribution, how to withdraw funds from a traditional IRA, how to distribute funds from an inherited IRA. You should have a better understanding of required minimum distributions and a better knowledge of taxable consequences upon distribution. When traditional IRAs were created in 1975, they were called regular IRAs. Your contribution at that time was limited to $1,500 or 15% of your wages, salaries, or tips. There are some advantages to investing in a traditional IRA. Your contributions may be fully or partially deductible. That depends on the type of IRA you have and on your circumstances. Generally, amounts in your traditional IRA are not taxed until distributed. That means the money grows over time without having to pay taxes until you redeem. Usually people redeem once they retire, and at that time their income is lower, and so therefore the taxes that they would pay on this redemption would be lower. A traditional IRA is really nothing more than a vehicle that allows you to invest in a variety of different ways in a tax-deferred manner. You can open up a traditional IRA at a bank, a savings and loan, a federally insured credit union, or the variety of qualified people that are trustees or custodians. You can invest in mutual funds, certificate of deposits, gold, stocks and bonds, certain limited partnerships. There are a variety of ways to invest in a traditional IRA that allows you to defer your taxes until a later date. Another way to invest in a traditional IRA is by purchasing an annuity contract and setting it up as an individual retirement annuity. You do this by purchasing it through an insurance company. There are some requirements because it must provide for flexible premiums up to the annual contributions limit. The problem with that is if your compensation changes, your payment may also change. Another way to set up a traditional IRA is by rolling over a distribution received from a 401k or other qualified employer plan. If you've retired, or you've changed jobs, or become totally disabled, you can make a tax-free rollover to a traditional IRA. You take a lump sum payment and roll it directly over to that traditional IRA and don't have to pay any taxes. You can open a traditional IRA and invest in that IRA even if you're covered by another retirement plan at work. However, you may not be able to deduct all of your contributions if you or your spouse is covered by the employer retirement plan. One of the nice things about a traditional IRA is the flexibility. You can open up as many IRAs as you wish, but you are limited by the amount you can invest each year. You may set up one type of IRA one year and choose another form the next year. And you may split your contribution between two or more investment vehicles. In other words, if you decide to invest $3,000 in a traditional IRA, you could put $1,000 in an IRA at your bank, $1,000 at a mutual fund, and $1,000 invested in a gold IRA. That's great flexibility. You can actually wait until your regular filing date of your tax return to make your deductible or non-deductible IRA contributions for the year. You don't have to do it by December 31st. However, you must make your contribution by that date. If you get an extension to file your return, you are still limited by the traditional April 15th date. Let's look and see what Frank does when he invests in his traditional IRA for the year. Last year he earned $72,000. He decides to contribute $4,000 to a traditional IRA. He can choose to contribute all of the $4,000 in a single IRA, or he can split the contributions into multiple IRAs. For example, he can contribute $1,000 to a certificate of deposit in a traditional IRA at his bank, $1,000 in a mutual fund traditional IRA, and $2,000 into an individual retirement annuity. We've discussed several benefits for investing in a traditional IRA. It gives you a way to save for retirement while deferring taxes to a later date. And then since your income will be lower, your taxes will be lower on these investments. It gives you a flexibility in investment choices. And it gives you just one more way to save beyond that qualified plan that you have through your employer. Now that we have a better idea of what IRAs are, let's talk a little bit about how to contribute to them. First of all, you can only contribute from compensation, taxable compensation. Compensation is generally what you earn from working. That includes wages and salaries, commissions, self-employment income, alimony and separate maintenance, and non-taxable combat pay. Now that we know what compensation is and what we can use to contribute to our IRA, let's talk about what you can't use to contribute to your IRA. Compensation does not include earnings and profits from property, interest and dividend income, pension or annuity income, deferred compensation, income from certain partnerships, or any amount you exclude from income. As we have just discussed, you now know that contributions must be based on earnings. In 2013, you may make contributions to a traditional IRA of up to $5,500. If you're age 50 or older at the end of 2013, you can contribute up to $6,500. This is provided that you have at least that much money in wages, salary, or net self-employment earnings in 2013, and that you have not reached the age of 70 and a half by the end of the year. As we've already discussed, contributions are limited by your earnings. If you earned income less than $5,500 or $6,500 if you're over the age of 50, the contribution limit is 100% of your pay or net earned income if you're self-employed. For example, let's say you just work part-time and you only earned $4,000 for the year. That means that you are limited to a $4,000 contribution to your traditional IRA for the year, even though the limit is $5,500 or the $6,500. If you have more than one traditional IRA, then that limit applies to the total contributions that you make to all of your IRAs for the year. So if you have 4 or 5 different traditional IRAs set up, you are still limited by the cap of your pay or net earned income if it's less than the $5,500 or $6,500. If both you and your spouse are under the age of 50 and you both had earned income in 2013, then each of you may make a contribution of up to $5,500 to a traditional IRA, even if one or both of you invest in your employer plan. If only one of you is over the age of 50, then that person can invest the additional $1,000 in contributions, so long as there is compensation to cover it. What if one spouse isn't working and doesn't have compensation or earned income for the year? Does this mean that they can't contribute to a traditional IRA? Thanks to the K. Bailey Hutchison spousal IRA limit, it is possible for a non-working spouse to make a contribution to a traditional IRA as long as there is compensation from the working spouse's income to cover it. Let's say that you didn't have earned income for 2013. If you file a joint return and your taxable compensation is less than that of your spouse, the most that can be contributed for the year to your IRA is the smaller of the following two amounts: $5,500 or $6,500 if you're the age of 50 or older, or the total compensation that's includable in the gross income for both you and your spouse for the year, reduced by the following amounts: your spouse's IRA contribution for the year to a traditional IRA, and any contributions for the year to a Roth IRA on behalf of your spouse. This is a great benefit for families who have one spouse not working and staying at home. It means that the total combined contributions that can be made for the year to your IRA and to your spouse's IRA can be as much as $11,000, $12,000 if only one of you is age 50 or older, or $13,000 if both of you are age 50 or older, as long as there is compensation to cover that amount. One of the limitations of a traditional IRA is that you cannot make contributions once you reach the age of 70 and a half. This is true even if you still have qualified earnings. But if that is the case and you have a non-working spouse, you may contribute to his or her IRA even though no contributions have been made to your own traditional IRA because you have reached the age of 70 and a half. Let's look at a couple of scenarios based on what we've just learned. Cindy is 16 years old and she works a part-time job at the burger joint. In 2013, she earned $4,500. How much do you think is the maximum she can contribute to a traditional IRA? Her maximum contribution to a traditional IRA would be $4,500 because she had earned income that was less than the $5,500 maximum contribution for her age. Of course, she can contribute anything less than $4,500, but that would be the maximum contribution she could make for the year. In this scenario, Aaron is 21 years old and he's a full-time student. He's unemployed and has no earned income for 2013. His grandfather gives him $2,500 to help with his expenses. How much can Aaron contribute to a traditional IRA? Because Aaron has no earned compensation for the year, he cannot invest any money into a traditional IRA. The money his grandfather gave him is not considered earned compensation because it was not taxable. In this scenario, we have one working spouse and one non-working spouse. Cindy works full-time as a real estate agent, and her husband James stays home to take care of their children. He has no compensation for the year. Cindy is age 49 and her husband is age 52, and they filed jointly. Her compensation for the year was $100,000. How much can Cindy and James contribute to their traditional IRAs? Cindy can contribute up to $5,500 to her traditional IRA and $6,500 to her husband's traditional IRA, since her compensation exceeds the maximum limit. Since James is over age 50, he is able to contribute $1,000 more to his traditional IRA. Let's look at one more scenario. John is 72 years old and he owns a small printing business, and he earned $80,000 last year. His wife is 65, but she doesn't work and have any compensation for the year. Can John and his wife contribute to a traditional IRA? Since John is over 70 and a half, he can't contribute to. This concludes part 1 of traditional IRAs. It's time for a few review questions to reinforce what you've learned.